Stephen Roach, do we need stimulus?
We certainly do on a near-term basis, Tom, because we've got a very vulnerable economy in the aftermath of the lockdown-induced sudden stop and growing risk of an aftershock. And the classic forces that give rise to double dips in the past, and we've had 8 double dips in the past 11 business cycle recoveries, is a vulnerable recovery and the risk of an aftershock. And we're setting ourselves up for a relapse later this year or early 2021.
Dr. Roach, the distinction here are Republicans who believe in austerity, Republicans looking at certain ratios and saying enough. What do you say to conservative Republicans?
Well, it's not clear that you can really say anything to deeply held views of politicians on either side of the aisle. I think this stalemate over the latest round of stimulus is most unfortunate given the still fragile state of the U.S. economy. Republicans know that. And quite frankly, Tom, I wouldn't be surprised to think that this is just a negotiation ploy by the president, playing for more of a rebound closer to the election than right now. So it's hard to really take all of this literally in terms of rushing from the hospital to pivoting dramatically on fiscal policy.
But Professor Roach, does this undermine, dollar longer term, even if it's not policy and it's an election ploy or a negotiating ploy?
Well, the key force behind the plunge in the dollar that I expect to occur over the next year and a half is a plunge in domestic saving driven by an exploding federal budget deficit. That plunge is underway right now. We had the sharpest decline in our domestic savings rate expressed in net terms of any quarter on record in the second quarter of this year, and that has pushed an equally sharp decline in the current account deficit. And the current account deficit now is a minus 3.5% of GDP, which is the weakest it's been in close to 10 years. And that fell sharper than it ever has since quarterly records were created. And the currency is a venting mechanism for a deteriorating current account deficit, and we're moving dramatically in that direction.
Stephen, is there anything in the next 18 months, whoever becomes president, that the next or this administration in a second term can do to try and stop that?
Look, the classic recipe to address a widening current account deficit is that you boost domestic interest rates or the currency falls. Those are the two escape valves we know of. The Fed has taken the interest rate option off the table with its new average inflation targeting and its promise to keep the policy rate near zero over the next several years. So absent the interest rate concession that foreign lenders normally require of a falling currency, the dollar takes the bulk of the current account adjustment more directly.
Steve, how do you respond then to the given shock, this natural disaster of a pandemic? How do you respond to the idea, and I'm going to think of Joe Stiglitz here, that the solution is to grow our way back to where we were? What is your timeline to grow our way back to where we were?
Well, the timeline is, we'll get there, but it's going to take a long time to dig out of the deepest hole we have ever gone into in a short period of time. And the markets are taking, as you know, Tom, with this, V-shaped recovery where we hit a bottom in June and there's nothing but upside. And I think that while the third quarter is going to be a sharp rebound, I hesitate to draw a line on the basis of an arithmetic, mechanical rebound from the sharpest decline on record.
Steve, I want to get to our next block. We're going to talk to you in about 7 minutes here about the firestorm of your weak dollar call. What will be the catalyst to jumpstart a substantial weak dollar?
Well, I think the catalyst is now underway. We saw the second quarter data on saving, domestic saving, and the current account itself. Yesterday, we got corroborating views on the sharpest decline in the trade deficit. These are all linked together, Tom. These don't come out of thin air. And when you've got domestic saving plunging back into negative territory, when you've got the current account deficit falling more sharply than ever before, and when you have a trade deficit that is exploding before your very eyes, despite the promises of a tariff war that would bring a quick end to our trade deficit, you're setting yourselves up for a precipitous decline in the currency. And the dollar is weakened somewhat, but it's only in the early early stages of what I think will be a much sharper decline. Well, saving current account dynamic gets worse.